You've worked hard and managed to save up $1,000, and now you're wondering how to invest your first $1,000 so you don't end up spending it on the next nice thing that catches your eye. You're to be commended for making that choice. Today, we will go through a handful of ways on how to smartly invest your first $1,000. And did you know nearly 70% of Americans don't even have $1,000 to spare in their bank accounts? So if you have $1,000, you're in the top 30% of the country. And of that, only 50% of them decide to invest that money. So now you're in the top 15% of all people who would wisely use your money. Congratulations! You're about to become an investor with your first $1,000. But before I begin, make sure you drop a like on this video, subscribe to the channel, and turn on notifications via the bell icon to be notified to benefit from the latest financial tips. With that, let's now discuss ways you can invest your first $1,000. Starting with the easiest and low risk and working our way up the list, the riskier, higher return ways to invest your first $1,000. Number 1. Get rid of debt. Getting rid of the debt you have over your shoulders is very important. Debt is something that stops you on your way towards becoming financially independent. Be it your car loan or your mortgage payments, get rid of these debts as soon as possible so you can actively start investing your money in places where you can earn good returns. Question yourself that, do you need that new pair of shoes? Or would it be better if you cleared that credit card payment that has been pending for months? Make sure to execute the right financial decisions for yourself, and that will start when you wipe out all that debt present in your name. Debt will hinder your money-saving tactics in the long run, where it will prevent you from accumulating a healthy amount of money to further pool into your investments. The rate of return for paying down debt equals 120%. And this is by far the best investment compared to the rest for a rate of return and lowest risk profile. Anyone with debt should pay it off as their first priority. By clearing off your debt, you get to more than double your capital investment. That is killing two birds with one stone. Number 2. High-yield savings account. A high-yield savings account is where you deposit your money and earn a higher interest rate on your deposits than you would with a traditional savings account. A traditional savings account has such a low interest rate that investing your money into this account will not be worth it. Instead, it would help if you were looking to work towards a high-yield savings account that gives you a good return. A traditional savings account will only manage to offer you an interest rate of 0.8%, while comparing it to a high-yield savings account, you can get a rate of 2 to 3%. This investment will pay more than your regular savings account, so even if you start with just $1,000 on your hands, you can expect your money to grow over time. The inflation rate is as low as 2 to 3% minimum, so by keeping your money in a savings account, you will actually end up losing 1% of it on an annual basis. By putting it in a high-yield savings account, your money is on par with inflation. Number 3. Government bonds. A government bond is a security issued by the government to raise money to support government spending. For instance, if the government wants to carry out the construction of a road but it doesn't have the money to do so, it will obtain a loan from an investor who is willing to invest money while the government issues a document stating that they will have to return that money to the investor along with the promised interest over a specific period. The catch in government bonds is that interest rates heavily influence them. These bonds are considered one of the safest investments on this list since they have no room for default, and the government will sooner or later return your money. A great starting point into the world of investing. That being said, the bond market is backed by the government, which is a poor investment choice relative to all the options out there, as the difference in return between stocks and index ETFs and bonds is so large that even with corrections in stocks and index ETFs, bonds are still a poor investment choice. Their annual return is only 2.5%, making bonds a very poor investment choice. The only good thing with bonds are they are an inverse correlated asset to stocks and index ETFs, so this hedges the risk of being in stocks and index ETFs. Number 4. Individual stocks. So many people choose not to invest in stocks due to they are high risk. The concept of high risk and high reward is explained in the best way by stocks. When you compare government bonds to stocks, government bonds are practically risk-free. But when we talk about individual stocks, there is every chance that a company might fail. Several factors might contribute to a stock failing. In the last year, Apple grew by 80%, whereas Tesla grew by 721%. This tells us that since investing in Apple brings us low risk, it is also low reward as there is lesser room for growth. You would never expect the stock of Apple to grow by an insane amount, such as 721%. In contrast, a company the size of Tesla can expect a rise of this percentage. Individual stocks bring a high risk with them, and the returns are high as well. However, finding a winning stock like this is quite low without encountering quite a few losing stock investments. Number 5. Index funds. If the $1,000 are all you have in your bank account, then maybe investing it into individual stocks isn't the wisest of options. A way you can invest in the stock market while also minimizing your risk is by investing in an index fund, mainly the S&P 500 index fund. This fund tracks the top 500 US companies, where some companies might fall, but most usually propel towards growth. According to historical data, the average return of the S&P 500 per year has been 13%. So, if you plan to invest in index funds with just $1,000, this might be your best option. Even Warren Buffett said he loves index funds the most out of all investments. To learn more about the S&P 500, check out our video linked in the description below. Number 6. Commodities. Trading commodities like gold and silver present a great opportunity, especially when they trade at a lower price. Commodities such as gold and silver provide you with a wide scale where you can invest your money. Gold and silver rarely ever show a drop in their prices, which is why it is another safe investment on this list that presents you with the lower risk options. Investing in commodities means you are usually investing in future contracts. A long-term commodity that will bring you good returns should always be looked upon as an option to invest in. And with $1,000 in your hands, gold and silver are safe and viable options you can invest in. The annual rate of return in commodities is modest, anywhere from 3 to 7% annually. It involves medium risk, so better to invest in it with the right knowledge. Number 7. Cryptocurrencies. One of the hottest topics in investment in today's day is cryptocurrency. While trading cryptocurrency might seem risky, it also brings with it a high reward. There is a staggering number of cryptocurrencies you can invest in right now. Around 3,000 are in existence, but only a few of these matter. The most important one being Bitcoin, of course. There are several trading applications which you can use to trade cryptocurrencies, and $1,000 is more than enough for a test run into a crypto bubble. Cryptocurrency is a game of high risk, high reward. It is risky to invest in, but the returns are the highest of all the options. And if you want to learn more, we have videos explaining cryptocurrencies and how to invest in them. Check out the links in the description below to watch those videos. Number 8. Portfolio diversification. Now, portfolio diversification isn't an investment option, but it's strategically very important to minimizing risk and losses. Portfolio diversification, or asset allocation, is the process of investing your money in different asset classes and securities in order to minimize the risk of the portfolio. If you invest all your money in a single investment, your risk exposure to high losses is dramatic. This is where diversification comes into play. You need to divide your investments over a range of investment options to make sure you hedge losses in the event one investment fails. The gains might not be as high as a single investment, however, the reduction in risk or loss is always more than the reduction in gains. Hence why portfolio diversification is widely used by the best investors. Ray Dalio and his all-weather portfolio is a great example of portfolio diversification. A link will be in the description to his book. We highly suggest you grab a copy. A $15 investment into a book can save thousands in a single year. Now, everyone has a different risk profile, which changes the way a person carries out diversification in their investment. But regardless, having a diverse asset allocation is key to becoming a successful investor. You could choose between ETFs, stocks, dividends, cryptocurrency, and much more. And a successful diversification is when the investments are inversely or non-correlated, which means when one investment goes down, the others don't. If you enjoyed this video, give it a like, and be sure to subscribe and turn notifications on to be notified when a new video comes out. To summarize, $1,000 is a good start to the world of investing. Whether it be in riskier, high-return options such as cryptocurrencies, individual stocks, or commodities, or in medium-risk, modest returns such as index funds, or in low-risk, lower returns such as bonds, high-yield savings accounts, or lastly, in a high-return, low-risk investment like paying off debt. Wherever you want to invest your $1,000, be sure to utilize the practice of diversification to guarantee that money will never be lost over time. And if you want to learn how your money will grow once it is invested, watch this video on compound interest as it will explain the magic that fuels investment growth. And I will see you in the following video very soon.